We're undoubtedly in the midst of an incredibly strong market bounce after the crash in March, and there are powerful option strategies that certainly profit from this climate. I'm Seth Freiberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the options trading style that we employ provides you with a range of prices over which you can win a trade. In this video, we'll be teaching you an easy, bullish weekly option strategy that you can employ on a consistent basis, which provides you with a solid win on the upside, has no upside risk, and interestingly provides you the potential for an even larger win if the market pulls back towards the end of the trade. So if that sounds like a trade you might like to add to your playbook, then stick around because I think you're going to find this interesting. Hi, I'm Seth Freiberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so we're in the midst of one of the most stunning market reversals in market history off of the March lows. And with interest rates low, the world seems to be turning to the equity markets for gains and return. And so it's obviously not a bad idea to have a few options income strategies in your playbook that can provide solid gains if the market rallies. The interesting thing about options income, though, is that you don't have to be right about direction to make really good money, and the strategy we'll be teaching you in this video, the broken wing butterfly, can actually win even if the market pulls back, and sometimes by a lot, even though it's a bullish strategy. So to understand how this can be, we're going to be looking at some examples that involve index options in the Russell 2000 index, and so we need to make sure that everyone watching understands exactly how index options work. If you're already familiar with them, just hang in there. We're going to do a quick review, and then we'll immediately jump back into the strategy right after this. Okay, so now almost all of you are probably familiar with equity options, where a call buys you the right to buy 100 shares of a stock at the strike price of that option anytime before the option expires, and a put option entitles you to sell 100 shares at the strike price of the put before that option expires. But there are also index options which work similarly to equity options, except there's no such thing as 100 shares of an index like the S&P 500 or the Russell 2000 index, like we'll be discussing in today's video. Well, you can't really buy or sell 100 shares of an index, but you can get paid in cash $100 per point if the index expires above the strike price of an index call that you buy, or alternatively, you'd be paid $100 per point for each point the index drops below the strike price of your index put. So, for example, if the SRUT Index is trading at 1350 and you buy the 1360 call, if the index closes at 1365, you'd receive $500 in cash in your account. If the index closes at 1360 or lower, on the other hand, your call expires worthless. On the other side of the market, if you buy a 1335 put and the market sells off to 1325, you'd make $1,000. But if the market just sold off to 1335 or higher, the put would expire worthless. So those are the basics of index options. And remember, you can buy options, but your broker will allow you to sell options as well. And your broker will also allow you to put together combinations of options. In other words, options strategies that involve both short and long options purchased in a way that is advantageous to you as a trader. Okay, so let's move back in time to May 19th. And as you can see, the Russell 2000 index was bouncing like the rest of the market. And so let's say on that day that we decided to enter a bullish trade. So we move out to the May 29 options chain, which expires in 10 days, and buy a 1250 put, which as you can see is almost 83 points below the market. And then we sell two of those 1230 puts. And then for protection, we head further down the options chain to 1180 and buy one of those. So this formation is what options income traders refer to as a broken wing butterfly. Now let's first examine what is happening here from a cash flow perspective, because that's going to be very important in understanding how this trade works. So as you can see, we bought the 1250 put for $14.25, but remember that represents $100 per point below 1250, so you multiply that by 100 for a total cost of $1,425. On the other hand, we sell 2 of those 1230 puts for 1075, and so that brings in cash of 2150. And finally, we buy one of those protective 1180 puts for 490, and so if you add it all up, you actually are receiving a cash inflow of 235 into your account. Your broker will require 2765, which is the worst case scenario on the trade, by the way. Now, before we get into how this trade plays out, which I think you're going to find interesting, I wanted to let you know that there are lots of other sound, viable long-term techniques for trading options for income. And in fact, we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 of those strategies that real professional options traders use, including a really simple but incredibly effective strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with the stock that you like, where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if those strategies would be of interest to you, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Okay, so as far as our broken wing butterfly trade, let's move now to the day that it expires. And as you can see, the RUT Index, the Russell 2000 Index, has closed at 1394, and therefore all of the puts expire well below the market. So now let's analyze what this means from an option standpoint. And as you can see, it's pretty straightforward. You see, all of the puts, whether we were long or short, expired worthless, because puts pay off only when the market expires below the strike price of those puts. And the highest put, the 1250, was more than 140 points below the market. So obviously, all of the options expired worthless. And so the implications of that are that the original credit we receive for entering into this trade, well, that becomes our profit on the trade because we have no obligations or value arising out of the options. They're all worthless. And so if you think about it, we tied up $2,765 of capital for 10 days, and we got an 8.4% return on that capital. So we were bullish, and we were right, and we were rewarded with 8.4% return. And that's great, but what's important to realize is that at any price above $12.50, we would have made the full $235 profit, which means that the RUT Index could have dropped 83 points from our entry price of $13.33, and we would have still made that same $235. Now that's not bad, but here's where it gets really interesting. So let's move forward to June 2nd, 2020, and let's put on a similar put broken wing butterfly set to expire on June 12th, again 10 days later. And as you can see, the RUT Index is trading at 1414 now, a bit higher than before. And again, as you can see, the highest put in this formation, the top long put, is at 1340, which is 74 points below where the market is currently trading. And so just like before, here's the cash flow analysis. I won't go through these one by one this time, but you can see that in total, this trade created a total cash flow of $265 this time, and has a slightly lower capital requirement of $2,735. So again, as we discussed earlier, if the expiring price of the RUT Index is at or above 340, the trade expires worthless. And again, we'd pocket the 265 if that were to happen. But there's another outcome that can happen when a broken wing butterfly gets very close to expiration, and that is if the market approaches the top put strike of the butterfly near the day it expires, like it did the day before expiration, which was June 11th in this example. So let's take a look at what can happen when this takes place. You can see that there was a big sell-off that day, 111 points on the Russell Index, which is a huge sell-off for that index. So let's go over to our cash flow analysis to see what would happen if we thought about closing the trade at this point. You see the 1340 put in a big sell-off the day before expiration really blew up in value and is now worth $17.65 because the market closed at $13.56, and with a big drop like that, the market was starting to believe that it may be very valuable upon expiration, because it's only 16 points below the market, and so it gained a lot of value. And so did the two short puts at 1320, but those are 36 points away from the market. So the chances of those having value are quite a bit less with only 1 day to go than the 1340 put, and so the value of those is fairly high also, 885, but basically erased by the value of the 1340 long put. And then of course, that 1270 put still retained value after a huge drop like that, because even that put, another 86 points away, could have value after a day like June 11th, and so those are going for $2.95. And so if you net them all together, you'll see that starting with the original credit and adding back the cash flow from closing the trade, the profit is $555, more than double the original credit received and more than a 20% return on capital in 10 days. So the weekly put broken wing butterfly, as you can see, is a powerful strategy that will provide a solid return in a rally and has the potential of a really tremendous return. Ironically, if a sell-off comes at the right time, it becomes sort of a bonus profit if the trade sets up correctly. That can be a handy tool in your playbook in a market like this where the bull is running wild, but the occasional pullback is inevitable. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so you won't lose this video, don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on the subscribe button right now so you won't miss all of the free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.